Diamond, he said, safe haven money is put into gold. The oil accelerates the belief in inflation growing. There is geopolitical uncertainty, things going on, whether it's politically or fundamentally based on monetary policy, that would have an effect on gold and it would take it higher. Wars is a big one. Any uncertainty, you could almost count on gold to have that knee-jerk reaction and move higher. My next level would be 43.90, that the central banks have begun to accumulate, except China. China has been accumulating all the way down. They've been aggressive buyers of gold and stuffing their central bank. You could say, well, what do they know that we don't? And with that as a caveat, the next level, 43.98, above that is, call it 45 to 46, with this up at 47. You can see that they both have these significant rallies up to an all-time record high. The same steps it took to go lower would be the stair steps it uses to move higher. Put the chart on in a second, but I think that the main thing that I've noticed, I'm not the only one, many excellent analysts, including Diamond, he said that the basic engine of what drives the connections between financial markets has pivoted. It's changed. And so typically, when there's heavy geopolitical issues, war, strife, things of that nature, safe haven money is put into gold. And the way one analyst put it is no longer does it go into gold, but rather it gets funneled to gold through a route, and the route is into oil. The oil accelerates the belief in inflation growing. That goes over to the Fed, which means now we're anticipating rate hikes, and then to gold. So that's what we're seeing, a key distinction between how gold has acted in the past as a safe haven and how it acts now. And we'll go ahead and pull up a chart and we can talk about that in specifics. Just let me know when you and your viewers can see it.
Yes, we can see it now. That's perfect.
Okay. So what we are looking at is a daily long-term chart of gold. This red here represents the all-time record high. And we had an extended rally, of course, multi-year rally, began in really 2016 with acceptable corrections. But once it hit this level, in 2 trading days, it would run from above 5,600 to a low, an exaggerated low, of about 4,400, the real bodies. And for those who are not that familiar with candlesticks, the difference between them and a bar chart is one subtle difference.
The market still calls gold a safe haven, yet its recent behavior tells a far more complicated story. Gary Wagner notes that geopolitical shocks now ripple through oil, inflation expectations, and Federal Reserve policy before influencing gold prices. That shift challenges decades of conventional thinking and exposes how macro relationships continue evolving beneath familiar headlines. Investors relying on outdated playbooks risk reacting one cycle too late. Next, Gary Wagner reveals why gold's recent chart may contradict the bearish narrative dominating financial media.
A bar chart has a vertical line. The top represents the intraday high. The bottom represents the intraday low. There's a little hash mark, a nick, on the left-hand side. That represents the open, and another hash mark representing the close on the right hand. So if you can imagine this as a bar chart, it would look a little bit different. If I can get there. Oh, this is a line. We'll go back, but it shouldn't be that hard. In a candlestick chart, we are looking at the same rectangle being the relationship between the open and close. If it closes below the open, it's red. If it closes above the open, it's green. Then there's these little wicks below and above, and they represent the differential between the real body, open and close, and the intraday low and intraday high. So when we watched this come down, it was brutal, but it recovered fairly well, even though it created what I call an exaggerated low. From there, it had its first lower high, And it came down and had definitely a lower low, moved back up with a lower high. This was not a lower low, but we had a series of lower highs, and they came in up until current pricing, which I'll kind of move to the center of the screen, and we still had lower highs, lower highs. But what happened that was different than what we saw before is we had consistent lower lows or a low form. And here we had one low, it pops up, and then it comes back down to about the same level. So a candlestick pattern would be called tower bottoms, tweezer bottoms if they were two apart.
Markets often reverse long before headlines admit the trend has changed. According to Gary Wagner, repeated lower highs reveal persistent selling pressure, but matching lows begin hinting that institutional conviction may be fading. Technical patterns matter because they frequently expose positioning before economic narratives catch up. Investors who recognize accumulation early preserve opportunity instead of chasing confirmation after the breakout. Next, Gary Wagner exposes the chart pattern institutions quietly monitor before major trend reversals become obvious.
So you definitely get a double bottom. But what we really saw unfolding was a pattern simply called on a chart to the Western trader is a W pattern. Obviously, you can see there is a great similarity between this, and this. These four lines look like a W. And the whole idea in a W, it's more of a common pattern, but it is exceptional when it plays out in providing insight that what we are witnessing is going to be a key reversal, a bullish reversal. And so there's little subtle things that we want to look at to see if it's following through, if it's unfolding as that. So you have resistance, and resistance is the apex of the inverted V. And so that comes around 4,200. And as you can see, we hit this double bottom, 4 green candles in a row, take us about $100 plus shy of this resistance. And my sense was that it would either go up to this point and on a closing basis break through, or up to this point, and then this would act as resistance. We don't know that yet, simply because today we had a $100 sell-off in the market. The little wick represents trading in Australia. So we have now opened below yesterday's closing price, and we have closed below yesterday's opening price. That doesn't mean that this will not be a one and done. We can see that as you look, here's one red candle, you get 2 red candles, 1 red candle. Typically on a strong downtrend, you see a series of red candles. On a rally or uptrend, you tend to see a series of consecutive green candles.
A single red day often scares retail investors more than months of institutional accumulation. What Gary Wagner is highlighting is that a developing W pattern only matters if resistance eventually gives way, not because every session stays green. Wall Street frequently profits by encouraging emotional reactions before technical confirmation arrives. Patient investors watch structure instead of headlines. Next, Gary Wagner unravels why trend strength becomes clearer when traditional candlesticks are replaced with a different charting method.
And we'll blow this down a little bit. And the way to really observe it is if we convert the standard candlestick chart to a Heikin Ashi, and that's what I've just done. And this chart looks a little bit different, doesn't it, Vlad, than the candlestick chart we looked at? It's kind of smoothed it out.
Yeah, 100%.
Okay, and the way that it does this, there is only one difference in the way this candle is drawn. The open on a candlestick chart is the true open. On a Heikin Ashi chart or a Japanese average chart, the open is derived from the midpoint of the prior candle. On a daily chart, the midpoint of the prior day. So it smooths it. So this is what illustrates the point I wanted to make. On a strong uptrend, you will see it building in body size, which means that the uptrend here is actually gaining energy. And at the point that it was to pivot, it goes right from one of the largest candles of this cycle to a red candle. You sometimes get a doji or a spinning top, but when you look at something like this, it's not as strong. You get a series of green candles, red candles, green candles. So it is going up, but you can obviously see that the strength of this trend is nowhere near as strong as the strength of this rally. And then when we get our sell-off, you've got two lonesome green candles. Body size starts small, and it starts to accelerate. And so that means that the trend energy, the pace at which it's doing this, is growing.
Institutions rarely care about noisy daily swings because momentum leaves fingerprints before headlines catch up. Gary Wagner's argument suggests that Heikin Ashi charts expose trend strength by filtering emotional volatility that traps short-term traders. That perspective matters because professional money often follows persistent momentum rather than dramatic news events. Savers focused only on daily price swings can easily miss the larger transition underway. Next, Gary Wagner reveals why one familiar support level may become the market's next launching point.
And so we get that, and it comes down to a certain area, which is about just below 4,400. We look back in time, we can see this was about 4,400. And so as it came down, it then broke through that, and then it broke all the way down the first of the double bottoms to 3,950. And then if I look back, I saw that that acted as a jumping point after selling off, consolidating to go into this long multi-month rally. So it met the criteria of a double bottom. The fact that it had come down so hard met the criteria of a potential W pattern. And when it did begin to move higher off of the second double low, what we saw was the first time that we had an opportunity to see a challenge. This was the last real lower high. A break above that changes that scenario, and now we have a higher high than the previous high. So it's easy to be an armchair quarterback. I'm looking at this back in time. It's much more difficult when we do this in real time, and that's why I like the Heikin Ashi chart. It tends to clarify the way we look at a market. But right now we had a lower high. I just put that in there, but that does not mean that by any means this trend itself, meaning that it could go higher, is over. This is one day. And the most difficult thing to ascertain in this market is the basic paradigms that gold tend to react to. So A plus B typically equals C. A, there's war in the world.
Missing one confirmation level can cost investors far more than enduring short-term volatility. This is where Gary Wagner's thesis shifts from identifying a possible bottom to demanding proof through higher highs before declaring victory. That discipline separates evidence-based investing from emotional forecasting during uncertain markets. Protecting wealth often means waiting for confirmation instead of chasing hope. Next, Gary Wagner exposes why geopolitical fear alone no longer guarantees higher gold prices.
There is geopolitical uncertainty. There are things going on, whether it's politically or fundamentally based on monetary policy, that would have an effect on gold, and it would take it higher. Wars is a big one. Any uncertainty, truly, up until recently, you could almost count on gold to have that knee-jerk reaction and move higher. Well, the war itself started, I believe, was it February?
Yes, February.
Okay.
Yeah, the end of February.
Yeah, okay. All right. So here's February, and it hits these really strong highs. That's when it goes above 5,600. There's a wick there. That's the highest level. And a low, lower high, lower low, lower high, lower high, lower high, lower low, and so on. And if you look in a textbook and you ask, what does a downtrend or a price correction look on a chart? You could answer it by saying, well, it's a series of lower lows and lower highs. That's the definition of what it is. So you can't make anything of it. You can't say it's consolidating. And the fact that it makes lower highs, you can't even say that it's recovering. And so now we have the opportunity to see that, this double bottom, but that will be invalidated if it doesn't trade and break above 42.30 on a closing basis and move higher. If it does, my next level would be 43.90. But the key is this is the first time, especially this year, we have seen the potential for there to be a conclusion to the rally. But we can't act too soon. Remember the last big correction, middle of 2011, beginning of 2012.
Wars grabbed every headline, yet gold failed to behave exactly as investors expected. Gary Wagner notes that a genuine trend reversal still requires breaking key resistance rather than relying on geopolitical assumptions alone. That disconnect exposes how financial markets increasingly respond to liquidity and policy expectations before reacting to dramatic events. Blindly buying fear can become an expensive mistake. Next, Gary Wagner reveals the painful lesson that permanently changed how he judges major reversals.
It's fighting between 1800 and 1900. I have to be honest, at 1900, I was a buyer. I thought it was going to 2000, and I was wrong. Valuable lesson that's carried me through all these years, where I'm not so quick to jump on that reversal bandwagon. Fool me once, but we need to see gold break above this resistance line, which is the last lower low that we've had in this long cycle, for us to correctly say that the correction continues. We would need some sort of a reversal, even if it went and did not close above it or went above it, but then quickly reversed. We would have to see gold trade below 39.50, because at that price point, we've run back into that cycle that it feels comfortable with. Lower low, lower high, lower low, lower high. And so there's nothing that you can make of it. One thing that gives me a ray of hope is that it was reported over the last couple of days that the central banks have begun to accumulate, except China. China has been accumulating all the way down. They've been aggressive buyers of gold and stuffing their central bank. Now, you could say, well, what do they know that we don't? And with that as a caveat, what we need to say is, well, you know what? Banks have endless pockets of wasted fiat currency that at any price, gold's going to maintain its value above that. But we need so much in circulation so people can transact business. But the fact that central banks are buying doesn't mean it's cheap. It's relative to what their currency is rated at.
Central banks rarely accumulate assets because today's headlines look comforting. According to Gary Wagner, confirmation matters more than optimism, even after experienced investors learn costly lessons from premature reversals. Meanwhile, official sector buying deserves attention because institutions often think in decades, while retail investors react week by week. That difference quietly reshapes long-term wealth outcomes. Next, Gary Wagner exposes why central bank buying doesn't automatically mean gold is undervalued.
And when they're rating them, they're not rating them how much is a loaf of bread now and how much was it last year. That's inflation. They're going, how much is this dollar worth when we compare it to a euro? That's a whole different dynamic. So when we say the dollar is strong, we're not saying it buys more valuable goods and services. We say that it buys more goods and valuable services compared to the euro, compared to the Swissy, compared to other nations' currencies. So you have to put that in light of that. But that's really what I'm seeing. We could see gold move higher. I don't want to come off as it could go higher or lower. I believe it has an opportunity to go higher, but it needs to prove that it can reach technical barriers and overcome that. Right now, the technical barrier is about 42.30. Breaks that and begins to go higher. The next level, 43.98. Above that is, call it 45 to 46. with this up at 47. You can see the same steps it took to go lower would be the stair steps it uses to move higher. And the way I always look at support and resistance is I'm right now on the first floor of my double level townhome. If I look up, I see a ceiling. That is resistance. However, when I go upstairs and I bang on the floor, that's support. It holds me. So support and resistance are identical. It's all within the viewer's domain, whether he's down looking up or up looking down.
A strong dollar can disguise declining purchasing power without solving inflation's deeper problem. What Gary Wagner is highlighting is that currency strength and real wealth preservation measure entirely different realities. Investors focusing only on exchange rates may overlook why gold responds to broader monetary confidence instead of headline currency rankings. Perspective often determines whether resistance becomes opportunity. Next, Gary Wagner unravels why silver's relationship with gold may surprise even experienced precious metals investors.
So support and resistance levels are interchangeable.
What about silver, Gary? Is it quite similar to gold? Are you sort of seeing silver as pretty much, gold on leverage to the upside and to the downside, or is it looking slightly different?
This is gold on the top, silver on the bottom. You can see that they both have these significant rallies up to an all-time record high. This one at over 120, this one over 5,600. We could look at the percentage gains. They both had brutal sell-offs, although gold was more quick to react. They both came and right around the same time had a lower high. So they have, I won't say they're trading in tandem, but there is a high correlation over time that they tend to move in unison.
Gold and silver rarely move identically, yet institutions often study their relationship before making major allocation decisions. Gary Wagner's argument suggests that strong correlation does not eliminate meaningful differences in speed, volatility, or opportunity during turning points. Investors treating silver as nothing more than leveraged gold may underestimate unique risks and rewards. Understanding divergence matters as much as tracking correlation.